Welcome everybody today to today's Lake Norman Chamber of Commerce program. This is a program on business growth, the employee retention credit. I'm Bill Russell, and Dale Gillmore is our business growth chair. And Dale, we've had a lot of businesses asking, what is the employee retention credit? And so you've got some panelists on here that's going to be speaking about it. And thank you very much for taking time. Dale is in sunny Florida traveling, but he's on business. And thanks for taking time out to do this. Dale, you want to introduce the panelists and get into a little bit about what is that? What is the employee retention credit?
Yeah, I'll start by introducing the team and then talk about everybody's kind of role in this whole thing. So first off, we got John Hettwer, who is president of Payroll Plus and also past chair of the Lake Norman Chamber. John, thanks for that. Certainly other things about John, but we'll save that for after the show.
Thank you for that as well.
Yeah. David Kostmayer, who is managing partner of Gbk PLLC, which is a CPA firm that serves Lake Norman in Charlotte, and they have offices in Mooresville. And David's a tax expert and a good CPA and friend. And then we've got Ron Niekro, who works with Quest. Ron is part of the team at Quest, serving. He's kind of tax director, all things director, serving our business succession, exit planning customers. But also we've done a lot with the PPP and had some involvement with the ERTC as well. So he's here as well to sort of see how that maybe interplays with the PPP. So we have John, who's got all the data at his payroll company for his customers. We have David, who is serving his customers on the CPA front and is dealing with PPP and, having regular conversations around whether or not they qualify for the ERTC. And then we've got Ron that's kind of paying attention to those opportunities as well, but also recognizing that, hey, wait a second, before you do that, we took the PPP loan, and that may have an effect on how we apply for the ERTC. So that's the group that we have with us. And before we jump in, maybe each one of you guys want to say a little bit about yourself, and then how often you're dealing with the ERTC. Go ahead, John.
Okay, thank you. Thanks for having me. Payroll Plus, I always tell a lot of our customers, man, it's been an exhausting last 18 months ever since March, because we started out with when the PPP came on. Obviously, we had the data for that. We knew we were going to be asked a lot of things relative to that. And we were very active with our clients, not just giving them reports, but for a large portion of our clients, or maybe I'd say maybe a third, we actually did the full loan to get to them to their banks, and then all they really had to do is sign. So we knew we were going to be dragged into it, so we took an aggressive approach and handled the PPPs for them, and that was very challenging and painful. We did the same thing with the PPP2s, but we probably did 20% of the PPP2s that we did for PPPs. In the early days, right, throughout 2020, we weren't too concerned about the ERC. And the reason we weren't concerned about the ERC, because there was a line in the CARES Act that said, if you take the PPP, you are not eligible for the ERC. And we looked at it for almost all of our clients. I got to be honest, I don't know if there's anybody where it made more sense to take the ERC rather than the PPP. And so it really wasn't heavily on our radar. And then in December 27th, President Trump signed, I believe, correct me if I'm wrong, you guys, especially from the CPA firm, is the CAA Act, wasn't it? Wasn't it the revised Trump plan that was December 27th that had one line in that basically said, you can apply for the ERC, even if you got the PPP. And the challenge then is you cannot use the same wages for both. So if you use those wages for PPP, you can't reuse those same wages for ERC. And so there's some calculations. So we've just helped our clients do that. And it's kept us really busy, and it's still going on, and there's plenty of time. It's not like this ship has sailed. There's a lot of time left to still take advantage of this.
Yeah, thanks for that, John. This is Ron. Kind of as a good background, because that's how we got involved. Was we were, again, helping business owners on a variety of things, but last year we all got in the middle of this and we helped with PPP. And you're right, the tax credit, the ERTC wasn't on the top of the mind because everyone was getting a PPP loan and it didn't qualify. But luckily, well, not luckily, but things kept changing, laws kept getting updated, rules kept changing, and we just tried to stay on top of it to continue to advise our clients with it. And so with what John was saying there, the changes late 2020, and the changes keep coming. IRS releases guidance slowly, but luckily a lot of it's been retroactive, at least applying getting the tax credit and what qualifies and what doesn't qualify. So here we are, still talking about it.
How about you, David?
All right. I guess I'm the CPA here. As Dale said, I have a firm in office in Mooresville, as well as one here down in Charlotte. We specialize in small business entrepreneurs that I like to be around those that like to grow their business, because it's always a lot of more fun and a challenging aspect when they've got a growth element to it. We have been dealing with PPP and ERC since March, April of 2020, and we too have not really put much effort into ERC until the law passed in December, and that changed our perspective on it. We've spent time helping people do their PPP loan applications, their forgiveness, and then now with the ERC, the idea of dovetailing those two and trying to maximize both the PPP forgiveness and ERC has been somewhat of a fun jigsaw puzzle type challenge, and trying to maximize those numbers. I don't know how many more of our clients still can use it, but in our year-end planning checklist, or we go over this fall with our clients as we meet with them, it's going to address, do they qualify for amending any of those returns for 2020 and now 2021. So that's my background.
Awesome. All right, Dave, I'm gonna stay with you. So why don't we back up for a second and maybe give, if you don't mind, give a overarching, what's the 2020 rules for ERTC and the 2021 rules, and maybe big picture, and then we'll ask more questions to get down to detail.
All right, so I break out 2020 and 2021 in two different, you got to look at two different ways. 2021 is pretty much all mathematical. You either qualify by the number crunching or you don't. Whereas 2020, there's a little subjectivity on that. There is a math component to it. If you fall below, if your sales fall below 50% of the prior year sales in the quarters in 2020, then you can qualify for up to 50% of $10,000 wages per employee for the year, not necessarily the quarter. So the math is one component of it for you to qualify, and that's the easy side. The other side is if you've been shut down or you've been affected by COVID, you've been limited. And the way we read that limitation and shutdown, in our firm, we went and put people to remote. We couldn't visit clients. Well, that was a limitation for us. So technically, since we're under 100 employees, we could qualify for the ERC because we were shut down, even though our sales may not have been reduced significantly, quarter by quarter. So in 2020, you have the two components. You have either the 50% deduction in sales, or you've been affected by COVID to see if you qualify. And then the credit would be 50% of wages up to $10,000 per employee for the rest of the year if you qualify quarter by quarter.
If you take the PPP, you've got to reduce those wages by the PPP allocation, right?
So when you go through that, so we've had a few clients that the ideal client is a client that had a 50% reduction in the first or second quarter of 2020 and did not restore prior year sales to 80% until the third or fourth quarter, or actually fourth quarter, because then you qualify for the ERC for the rest of the year. So you can do your PPP loan, extend it over to 24 weeks, and you should be able to find $10,000 per employee of ERC wages that fall outside the PPP forgiveness number. And for some of our clients, when they wound up paying family members PPP money because they had it, that would not qualify for the ERC. So we spent time, pushing as much money to family members in PPP forgiveness numbers and not using those for ERC because they would not qualify for it. And then figuring out how to, sometimes let's say we had some that only qualified for ERC in the second quarter. So we had the 24-week option on PPP forgiveness. We just used PPP funds that came out, in the last part of the 24 weeks and utilized that as much as we could. So there was a play and a balancing act between what you use for PPP forgiveness and what you use for ERC. And that works if people had not filed their PPP forgiveness forms yet. Once they filed for forgiveness, the wages they used in that calculation was kind of boxed us in on the ERC calculation.
Yep. Okay. So you're talking a lot about the art of the interpretation and allocations and obviously the whether or not you've been impacted by COVID or the pandemic in a way that has hurt your business. What about 2021? What's different 2021 versus 2020? I understand it's just math, but
yeah. So math now is it's $10,000 per quarter instead of essentially you do the test each quarter. It's 70% of the 10,000. Your credit per employee is now up to 7,000 instead of 5,000. But in order to qualify, generally you have to have you have to have reduction in sales of greater than 80% from the same quarter in 2019. So if you qualify in Q1 21, your sales in 21 can't be greater than 80% of the sales in Q1 2019. And that same quarter apply, you do that test each quarter, and each quarter, if you qualify, you can take the ERC credit up to 70% of 10,000 wages per employee. Again, family members don't count. Owners don't count unless for some reason you happen to be an orphan and have no heirs or family members that are alive, then your wage could count. There is a special rule out there that you can go back. Let's say in Q1 you don't meet that test, you can go back the previous quarter and say, you can qualify for Q1 21 if your Q4 2020 sales are less than 80% of the Q4 19 sales previous one.
Yeah, it's you look at Q4 2020 and compare it to the same quarter in 19.
Yes.
If
So
you
you can go in and do that previous month each time. So let's say you do qualify for the previous month in Q1 and in Q1, but you don't in Q2. Well, you can go and use Q1 twice for that matter. At least that's how I read it. You use it for Q1 and for Q2 because you can use the previous quarter in that test. You're not bound to stick with the previous quarter. you can make that election each quarter on its own.
So this question.
I just wanted to, and I still read it as the government order test still can apply. Just maybe less of a chance that there's a federal, state, or local order that is fully or partially suspending operations, by limiting travel or group meetings or commerce.
You see that in 2021 too?
That was my understanding, yeah.
I've not seen that. I didn't see that in any of my readings of it, but is that a new change or what?
I don't
That's
know.
not in the new. I didn't see that in the rules how that applied to 2021.
Yeah, I still had read it, the eligible employers, there's a two test part, right? The gross receipts test and the government order test.
Okay. So John just lost power, so he's trying to join us back here in a second, but something happened. Anyway, we'll see him in a second. But one of the other questions that I have,
I don't think it's going to be a second, because I've seen notices that areas like Huff High School is no power. 115 in Bailey Road area, no power. Go ahead, sorry.
That's all right. We'll survive one way or another here. So the next piece that I think is really significant in this whole thing, and we've kind of gone back and forth on this and in other arenas, even with the PPP, is, how do you have, how do you measure gross receipts? Is it, how do you file your tax return? Is it accrual basis? Is it cash basis? Is it, can you go back and forth? What are you guys kind of thinking through that? Maybe Ron, you start, and then Dave jump in after.
Yeah, my reading, my understanding is it's going to be gross receipts, all gross receipts. The exceptions I've seen is like the loan forgiveness, PPP loan forgiveness income, like that type of income is not included in gross receipts, but otherwise all other gross receipts. And you're going to calculate your gross receipts based on the method you use to file your tax return, your income tax return, right? So if you're accrual basis, you're going to calculate your gross receipts on accrual basis. That's how I file your tax return. If you're cash basis, do it that way. So there are some, go ahead.
No, so my question would be, and what if you maintain your books on the accrual method, but you are a cash basis taxpayer? Does that give you the opportunity to choose whatever's best for you?
You can try. I think I've seen an IRS answer. It's an IRS answer, right? So it's not necessarily it's their position, but it was consistent with filing the income tax return.
But then
you could do an accounting method change, I guess.
Well, I got a call in here all of a sudden. I'm on my phone and pushed me out there. My thought was if you keeping your books on an accrual method and you're keeping track of accounts receivable and everything like that, that still affects your ability to generate cash down the road, even if you're a cash basis taxpayer. Then I also took the position that if you're a cash basis taxpayer and you're reporting income that way, that could be an argument of why your sales are that number. So to me, if you're maintaining an accrual based financial statements and you are a cash basis taxpayer, you may actually have an opportunity to argue both sides, whatever gives you the best answer.
Yes, that could be a position. And the other thing to say that is with again, I think the flexibility that they've added for 2021 to look at Q4 2020 or look at the previous quarter, all trying to give that flexibility to, I want to say, qualify as many employers as possible.
Yeah. Yeah, and that's kind of the position I took on a lot of these things where when there was in doubt, the idea was to help support. So therefore, we would take the position whatever we could that wasn't flying in the face of a direct rule or interpretation to do what was best for us.
So kind of jump back out of I'm going to pull you guys sort of out of the weeds now, and and jump back to the sort of practical, let's assume I'm a business owner, and, I kind of see a couple different categories of this, right? There's sort of somebody that's been tracking it all along, and to be able to do that, you have to probably be pretty close. And I don't know Hettwer is in a power outage, but you have to be pretty close to your payroll, and you have to be on top of the rules to be able to do it timely on your 941s, right? So what's that look like now? I mean, are most of your clients actually just having to amend their 941s to take this, or did any of them actually catch it on time to process it, with their quarterly 941s? That was going to be a question for Hettwer, but I figured I'd ask you, Dave.
Might have been pretty much amending. I've got 2 stacks right here, or 2 ERC amended returns that I have to review here on my desk. We just, there may be 1 or 2 that for 2021, they're on top of it now. But the idea of, anybody in 2020 was pretty much going to amend it, even in the fourth quarter, because it was too much to try to run through our bandwidth in January, because that's a big, our payroll department is slammed that month getting the year-end stuff. They weren't going to add anything new like ERC calculations. So we're mainly amending our returns.
Yeah, I think it's mostly amending that I've seen. Although, I mean, again, the rules allow you to reduce your payroll tax deposits as you go for the credit, so you're not just getting the refund. But I think you're gonna, even though there's math, since there's math involved, unless you know you're going to easily qualify under that 20% reduction in gross receipts, some may have to wait to the end of the quarter to know if they even qualified.
Yeah, I did see where the new rules that came out, which I really don't agree with. It's unfortunate, is that they said if you took the credit for 2020, you need to go back and amend your 2020 return and reduce your wages for the credit. And I have people we filed in March of last year that we still have not received the ERC funding, and they're cash basis taxpayers. So why would we go back and amend and report income on cash the IRS is sitting on still? So I don't know if I'm going to follow that rule, because I would take the position they're cash basis and it's not in their possession yet.
Yeah. And I've seen, I think most of the clients that have amended are still waiting for that refund for the most part.
Yeah. I've only had a couple of them that have come in, and I don't know if it's because they didn't take PPP, or when they qualified it for it, it was a slam dunk, or maybe I'm not sure why a couple people have it, or they just approved it. They got in early and they proved it and they got in the right stack. But
yeah, that makes it the best option, is to try to reduce your payroll deposits for the credit as you go, if you can.
So
getting the refunds might take a while.
If I could jump in here, and again, I apologize, I lost all power and I had to change locations, and I got a text from Duke that there are some people affected. But here's what we're doing. If you are not getting your ERC, it's not coming quickly. I'm talking to about 100 different, I'm in some trade associations. We're talking about 100 different payroll companies across the country. And we kind of report back daily of who is receiving an ERC. Now, I've gotten one customer that I did get it back on, that they received theirs, but for the most part, they are not moving, and the IRS. And it seems that 2021 is getting processed better than 2020. And because I don't think the IRS knows how to process them. But then another thing hit me this morning, and that is, don't forget that we have this whole issue of the debt ceiling limit. And they are now taking measures to protect their cash because of the debt ceiling. I would not be at all surprised if the ERC wasn't one of those going, we can't get the money out to people, because those are some big numbers going out the door. And I just suspect that it's just not moving fast. So that's just the experience that I'm having from across the country. Nobody that I can see, other than dribs and drabs of maybe one service bureau would have one. We've had one, and the challenge is this. I know it'd be great to take it as a credit, but from a payroll service standpoint, if you have a payroll service, and I'm talking about all the majors and payroll plus HCM as well, that's a very difficult reconciliation process to try to take a credit payroll after payroll after payroll versus waiting for the check. So I don't know of many payroll companies that are doing that. They're just filling out the forms to get the check, and a lot of customers want that way because they can easily track, hey, I got my amount.
So lifting you guys all back out of the weeds, and thanks, John. I'm glad you're back. What do our customers, what do they need to have a conversation with you, David? And then, in some cases, I see, John, that you're actually filing some for your customers and taking care of your customers, which is great. There's lots of cases where payroll companies are like, hey, that's a business decision of yours, and they come to the CPA firm or whatever. But, David, what are you asking your customers to provide you to be able to make these decisions? And then John, maybe jump back in, because there's a part of the CPA world that you don't have, which is the reduction in receipts and things like that. And how are you guys kind of dealing with that, as maybe potentially complements to each other, from service? So what's your information request look like to your customer?
Oh yeah, information request. We are asking for, sales numbers to see if you qualify and how you qualify for it. So if you follow under the math numbers, that's the easiest way to follow. If not, we're going to have a narrative conversation about how you were affected, if your customers were affected. We've even had people we've applied for that had a growth in revenue, but they had a whole division. They almost had to rebrand their whole company. Their whole 90% of their existing customers kind of went away for 2 weeks, and then they changed their customer base and took off. But we qualify. I felt like we qualified for it because that 90% are still their clients. They just weren't generating any revenue. So we'll have a narrative about that. Then we look in payroll records, get your 941s for each of the quarters. And
so is that 2019, 2020, 2021 receipts and payroll records quarterly?
Payroll, not 19 payroll, 20 payroll, 21 payroll, 19 sales, 20 sales, 21 sales.
On a quarterly basis?
Quarterly basis, yeah.
Okay. And just for perspective, on the payroll side, this might be helpful for John. What's your assessment of the landscape of, the PEOs versus the other payroll companies that aren't Payroll Plus, and how, are they on top of things like John is, or how hard is it to get what you need to be able to assess that on the payroll side?
From a PEO perspective?
Whether it's a PEO or another payroll company,
another
or
payroll
whether
companies,
the folks are doing it in-house.
Yep, the payroll company or in-house are easy. PEOs are virtually impossible to do what we need to do, unless you're right on top of. We're part of a PEO, and we felt like we qualified for a portion of that, and we can't get our PEO to get things around to file the amended returns that we need to, or get our credit available. And I feel like that's the same thing with a lot of PEOs, because you're just in one big.
About that.
But from if we qualify going forward, we probably could put that into our system. We just don't qualify. So PEOs seem to have a challenge in itself, and it did for PPP too. We struggled to get PPP funding for clients and ourselves for those in PEOs, because you couldn't run a 941 just with our tax ID number on there, and some banks had a difficult time getting past that narrative.
Yeah, understand. So PEOs require extra step and care and communication.
Mhm.
Clients that are doing it themselves internally, you can fish the information out pretty
Yeah.
easily. And folks that are using payroll companies, that information is typically pretty easy. But the question is,
Yeah.
are they a hands-on payroll company like John, or are they, just filing 941 saying, you guys got to let us know what changes you want to make?
Yeah.
Okay.
And Dale, if I could jump in. So what we're doing to help our customers is we, you were talking earlier, it is a revenue-based or the situation of if you had a closure of some sort. Well, all the restaurants had closures pretty much all of 2020. So they all qualify regardless of revenue. Of course, they have revenue to support that as well, right? And there's other vertical industries in the same boat, okay? And so for us, what we're really looking at is, okay, help work with your accountant and us to say, what quarters do you qualify? So the really first step is, what quarters do you qualify? And then you kind of qualify individually for 2020, second quarter, third quarter, fourth quarter. And there's the threshold of how much revenue you can use. And you guys may have covered that while I was gone. Once we say, yes, we qualify for those quarters, then of course we have all of our customers' data that we can go in and slice and dice that. And we have a whole process to maximize the ERC, because remember at the outset of this Zoom call, I said you cannot use the same revenue for forgiveness as you could for ERC. Well, you can use up to $10,000 of your wages for ERC. So the truth of the matter is, in that scenario, we are actually looking at individual employees, and anybody who didn't make $10,000 in that company, we are trying to cut them out of the forgiveness model to make sure that we still had enough to get full forgiveness. And that allows them to preserve all those funds and it's worked almost every situation that we can show that by even cutting all the 10,000 and everybody who made less than $10,000, if you're eligible throughout the year, we were able to do it. And the calculation changed a little bit if you're just allowed for second quarter, or you're just allowed for third quarter, or you're allowed for third and fourth quarter. So there's a lot of calculations that we look at, but it actually involves going down and looking at the individual level, which is why it helps us to have that data. But we really work with the accountant and or them to determine what quarters from a revenue standpoint and from a closure standpoint, because they know for their particular industry.
So, John, one of the questions that I had for you is specific to, we're talking basically all the stuff that David's working on and then Ron's been a part of is these. People are amending their tax returns, and so for you, it's been probably pretty hard to be seamless to just process a 941 with it in it, but maybe you're closer to it and have the best chance to be able to do that. How many of those are always? I mean, how are you amending all of those, or are there some of those that you're what's the amendment process look like maybe for you versus
Right.
David?
So,
and then what amount are actually making it through without having to worry about amending?
Generally, especially if you're looking, and the focus too is on 2020 ERC right now, and you can always amend the 2021s, but the real big dollars are in the 2020. And if you're whatever quarter that you're available for, we amend those that's part of our process. We have to amend those 941s. Now, and I understood you guys talking earlier of, okay, how do you account for that? Because I think what it is a challenge, because now you have an amended return and you have to do your tax return. So do you include that or do you not include that? And there is a lot of confusion in the market. I agree with what you guys were talking about earlier, is you don't have the money, so it's hard to claim and file a tax return as if it's a credit, other than it's account payable. And if you're a cash basis, you don't have that accounts payable. Accounts receivable, I guess. But the net is that's kind of how we're dealing with it, is we go in and amend the returns. And so the reports that we run have to do with the pay dates of that quarter, and we have to amend on per employee what is their new or revised revenue, even though that doesn't show up, or wages, even though that doesn't show up on the 941. So we amend the 941s in the quarter that they need, and then ask for the check as opposed to trying to carry it forward, because again, that's an administrative challenge for all payroll companies.
Yeah. Okay, one more question here for Ron. We talked about the PEOs and how some of them have it together and some of them don't. And whose credit really is it, and how's that make it back to the employer, or the co-employer, so to speak, the small business, and what, I guess everybody's different. We've dealt with this on the PPP side a ton, and we've seen different reporting. This is sort of a kind of a little murky water here, but I think there's probably opportunity for John to pick up clients that are with kind of bad PEOs that aren't really tracking much. What have we done? What have we had to do to sort of piece together stuff for the PPP? And then, when the data wasn't great, and then what's advice you might give to an employee, president of a company or co-employer that's using a PEO, and how to navigate that with a PEO?
It's there's a lot to unpack there, because the PEOs are different. The bigger, there's larger ones that can be easier or harder to deal with. I think getting them, trying to get back to your question, getting to maybe the right person at the PEO to get reports, and having them understand kind of what you're looking for. I mean, it's been an exercise, but once, that was kind of the first time around, especially for the PPP, was exercise. I mean, the second round, and this is more for all kind of payroll providers, including PEOs, is they all started building their own reports, and building special reports. I guess what we were still finding with some of the bigger payroll providers is the whole, and that, again, it's going to get off topic from the tax credit, but it can be part of it. But with PPP, the paid versus incurred, and including both for what would be included in covered wages, is really, sometimes we had to go into detail and get weekly payrolls or biweekly payrolls and compare them to what the report that some of the providers were preparing and sending, and finding that they were missing a payroll. So really, in some cases, it just maybe work. With some of that though, if you just think, when David mentioned what's the eligible wages for the credit, right? It's the first 10,000. So if you have, again, depending on where your compensation level for your employees, maybe it's not going to matter too much if they're already over those limits anyways, because you're going to take the first 10,000. Or with the PPP, you're going to use a whole 24-week period, so you're going to be over the 2.5 months the loan's based on. So
yeah,
you can go in a lot of effort, but that's sometimes it's stepping back and seeing, do I even need to do all that? Because I may have enough compensation to maximize both anyways, and not get too far in the detail. So and some of that's just getting back to the big picture, I guess. And
Dale, if I may jump in there, because I think there's a couple of points to be made there, just so that people out there are aware, is with forgiveness, right? Because in this thing, there's a lot of, we're talking about PPP, but the important thing is not the PPP so much as the forgiveness for the PPP, right? And that's where we're talking about the wages. With forgiveness, you can use your family members because they are paid wages, because they compare it to 19 and things like that. With the ERC, there is an extensive list that keeps you from having family members. And it's not just spouse or daughter, it is aunts, uncles, nieces, nephews. If they're working in your company, you have to exclude them for the ERC. And so we put them, of course, use their wages for PPP, even if they're under 10,000. And the other point to note is owners, the $100,000 rule is a little bit different, right? So employees, you could have $100,000, you can take 24 weeks, and it works out to be $46,000 is the max for your employee. However, if the owner was paid $50,000 last year in 2019, you're only allowed 2.5 months. So you got to look at not only what employees you want to include, but you have to do a reduction for the owners to make sure you're not over stating what you're allowed to use for ERC. And you have to actually eliminate the extended family. And so because you eliminate extended family, you can use their 100% wages for PPP. So there's just a lot of gyrations. And obviously, all of us who are out there working on this took a lot of time, energy, and effort to figure out all these rules. And so that's why when I don't fault any payroll companies on they don't know what they're doing, because it isn't easy. It was a lot of effort, and we're still trying to keep our customers happy, trying to do it fast enough because of the inordinate amount of rules that came through over time, and just figuring the best process to get it done.
Yeah, one last point to make with the PEOs. What we've also learned is that the PEOs that are probably doing it right have something that's equivalent of a 941. I can't remember if it's a 941X or L. I don't know what it is, but equivalent of a 941 for your company. It's not really truly a 941. It's just a way to segment the businesses within the PEO. And we found there's PEOs that aren't doing that. And to me, I was surprised that is, okay, because the IRS created this forum to segment the co-employers and I'm not going to say names of PEOs, but we found some PEOs that aren't doing that, where we learned more about that with other PEOs that were doing it because it was helpful for us. And so I would just make sure you understand who your payroll providers are, your PEOs, and how they can help. You're going to need your internal controllers and bookkeepers, and you're going to need your CPA, and you're going to need your payroll company, and you're going to need them all to work together to be able to maximize your opportunity with the ERTC. And obviously these rules are very complicated. We have 3 smart people that still are going to have to take, an hour to decompress after this Zoom call to relax and enjoy themselves. And I'm going to enjoy the rest of my day here in Miami. So, Bill, thank you for being our fearless leader of the chamber. And you guys, thank you so much for being on the panel. I think I would say that it's pretty clear that even if somebody watches this over again, they're going to need, 3 to 4 teammates to execute this well.
Dale, before we actually sign off, we have 2 past chairs of the Chamber of Commerce, one a CPA, Jay Leisman, and the other Richard Pappas, a banker of First National Bank. I don't know if either has a comment or a question of the panelists before you actually sign off. I see Richard.
Yeah. No, this was great content. Thank you, guys. This was really good, and it's a lot of information. It's very confusing for our clients. So I appreciate you guys taking time out and giving us this overview. But I agree, it's incumbent upon us as bankers to advise clients to get with their CPAs and other professionals like you guys and understand all these benefits. So thanks so much.
Jay?
And I will chime in with Richard and just saying thank you all for doing this. This is something, Dale, you kept on saying, let me pull you all out of the weeds. Well, this ERC stuff is nothing but weeds. And it's very difficult to understand. And in fact, I know that, it takes a long time to walk through the process. And thank you all for doing that. And, it's a difficult thing, especially when people are just getting credit. They aren't seeing any activity with the amended or the credits that they've already asked for. It's like, well, do I even go through the trouble? But you all hit a lot of good points. So I'm sorry, what?
They have to keep a quarterly inventory of what claims they have out there.
You're right.
You're getting stacks of 6 and 7 quarters now. And
there is no carry forward. On each return. But thank you all for talking about it.
Dale, thank you again for pulling the panel together and for being our business growth chair. You put together a lot of these programs and they've been very valuable for the Chamber of Commerce. As a reminder, this has been recorded. We're going to be placing it on our YouTube channel. We'll be getting it out there in emails. We'll put it on our website and get it on our social media. So thank you to the panelists. Thank you, Dale. Thank you to the guests. Everybody have a great weekend at the lake.
All right. Thanks.
Thanks, guys.